Hello and welcome to Ipsa Dixit, a podcast on legal scholarship. I'm your host, Brian L. Fry, Spears Gilbert Associate Professor of Law at the University of Kentucky College of Law. And my guest today is Todd Zywicki, Professor of Law at George Mason University, Antonin Scalia Law School. And we're going to be talking about Todd's work on consumer credit regulation.
Hey Brian, thanks for having me here. Nice to talk with you.
Of course, thanks. The pleasure is all mine. And I really enjoyed the talk that you gave earlier today. Packed an awful lot of ideas into a very short time frame. Of course, I've heard you speak many times before, but not on this particular subject. And one thing I was hoping you could do, because I don't think it gets enough attention, is to talk a little bit about the kind of the historiography or the intellectual history of consumer credit scholarship and ideas about consumer credit, what's it for, and how it works. Because I think people often feel like this is sort of a new field that came out of nowhere, and I think you really did a great job of explaining how that isn't the case.
Well, there's this idea, or sort of a myth that people have. Lendl Calder, the economic historian, calls it the myth of lost financial virtue, which is everybody believes that this is the generation that's gone to hell, where people are living beyond their means. But you can go back and basically look at every generation for the last 150 years where everybody thinks we've lost the frugality of prior generations. And that helps to frame a context to understand the study of consumer credit and consumer credit regulation as well, which is the modern era of consumer credit really starts when people moved into the American cities at the beginning, late 19th century, early 20th century. People left the farms, immigrants came in and had to deal with sort of the wage economy, periodic job loss, unexpected medical bills and that sort of thing. And it put a lot of stress on the traditional way in which people lived within households. We also started getting the early glimmers of the development of the consumer economy as people started buying things like pianos and radios and sporting goods and things like that, and then of course cars. And so the consumer credit really, sort of middle class consumer credit, goes back to the beginning of the 20th century. Certainly by the 1920s, we started to see a lot of use of consumer credit. And along with that then comes the first efforts by economists to try to understand how and why consumers use credit. And in particular, back in the old days, what we originally saw was installment credit, or what is called buying on time. And sort of as the consumer credit economy has developed, economists have thought about it, and credit cards obviously are a big change. But there is a long, robust body of research studying how consumers use credit, and it's not just just a new idea.
So it sounds like what you're saying is that something really dramatic happened in both the consumer credit market, but also in consumer credit scholarship sometime in the 1920s. I was wondering if you could talk a little bit about kind of what changed at that point in time and what people started looking at.
Well, two things happened in the economy that then led to increased academic interest. The first thing was what we saw in the onset of the 20th century was this great migration to the cities as people left the farms and immigrants came in from abroad. And for the first time, we really had to deal with the problems involved in a wage labor society, cyclical unemployment, unexpected medical bills, and things like that gave a need for people to be able to get access to credit. The second thing that happened was the dawn of the consumerist society. And what we see is the invention of radios, pianos, things like that, and then later cars, of course, that put a huge spurt to interest in consumer credit. And these are all consumer durables, which are kind of like almost like a business investment where people can purchase something and it generates a flow of services over time. Perhaps the best example was Singer's sewing machine, which became most famous for its credit program. And that was a good example, which is housewives could use the sewing machine basically to create clothing for their family, but also often took it in piecemeal for textile companies and that sort of thing, and would actually produce clothing that would then be sold in shops. And so what we saw was all of a sudden this logic of consumer credit to smooth income and expenses on one hand, and to buy consumer durables on the other, such as radios and furniture and appliances, created a great demand for credit. That then in turn led to the first academic studies, and there was a economist named Seligman at Columbia who wrote a 2-volume study in the 1920s on installment selling, which was this practice of buying on time where you'd make monthly payments. Seligman sort of first studied this, and then as we went through the 40s and 50s and into the 60s, as the consumer economy grew, consumer credit grew with it, and the study of consumer credit grew with it as well. Unfortunately, beginning a lot about the 1970s or 80s, the study of consumer credit fell out of favor in universities, and a lot of people didn't study it at that point, and they feel kind of went dormant, only to really get a big resurgence of interest after the financial crisis in 2008.
Right. So I'm really interested in your work on more recent events in consumer credit, but I've never really heard about this sort of shift in the 1920s. So I just want to follow up on that a little bit, because it sounds like the introduction or expansion of installment contracts was really important in developing or changing the market or availability of consumer credit. And I'm kind of wondering why that happened and sort of what people did before that happened. I mean, did the availability of installment contracts come from demand, or did something in the regulatory market or something in the broader kind of financial markets change that made it possible when it wasn't possible before?
Well, a variety of things were going on at the same time, right? First was just economic growth in the United States, right? And people getting more money, and getting more money meant that they wanted more of the good things in life, whether it was books and encyclopedias or pianos or radios, right? And people wanted that, and there's really no need to save up for it if you can finance it, right? The example that I give when I talk about this is cars, right? And what really spurred middle class access to automobiles was the creation of the General Motors Acceptance Corp in the 1920s, where you could buy a car and finance it and drive the car. And as I say, Ford's response was you could buy a car on layaway, which is send them a check every month for 10 years, and eventually at the end they might give you a car, right? Meanwhile, ride the bus. Well, if you understand why that doesn't make sense to buy a car on layaway when you could be using the car and financing it out of the increased productivity you have essentially from the car, then you understand why that doesn't make any sense, right? And so this starts to grow in the 20s as people become more prosperous, as mass production increases, so that a lot of these goods and services come into the means of middle class families. And installment selling rises up beside that on a very localized basis. Department stores, furniture stores, clothing stores offering the opportunity for people to buy things on credit. This then has a huge effect on the economy, which then leads economists to start thinking about it, understanding this new phenomenon of being able to buy for things when you don't have the money. And another way of thinking about it is it's a way of actually saving, if you think of it that way, which is that what's the value of a washing machine? It's not having to schlep to the laundromat every weekend with a pocket full of quarters, right? If you have a car, it's not having to pay bus fare, or not being limited in the places you can go, because a car gives you great freedom to live in different places and work in different places and things like that. And then, of course, the great boon to that then is the post-war migration to the suburbs, beginning in the 1940s after World War II, and the whole expansion to the suburbs was financed by credit. Levittown was conquered by credit, essentially, right? When you moved from an apartment in the city, you had a house with a mortgage, you had to get a car because you had to commute, so you had a car loan, you had to get furniture for the 3-bedroom split level, you got all the appliances. All that was financed on credit, and it went hand in hand with the growing economic prosperity of the middle class in the post-war era.
So you're talking about a period that in some ways sounds familiar, but also sounds really different in one really fundamental way. And that way for me is that you haven't used the word credit card yet. And I'm wondering sort of what role the development of credit cards and that kind of consumer credit played in this story that you're telling. Is it similar to the way that previous forms of credit worked? And I guess my question is, how do people use credit today differently from the way that they use credit in the 20s and also in the 50s and 60s?
Well, that comes back to your key point here, Brian, which is that there's a lot of historical myopia when we think about consumer credit, which is in many ways things are more similar than different, even though people think that sort of the the whole world went down the drain when credit cards were invented in the 80s. In reality, credit cards are just a more efficient way of doing what we did previously. So if you look at the data, for example, in the 60s and 70s, consumers were using all this installment credit. If they wanted a bedroom set, they would open up a line of credit from the furniture store and pay it off in time. If they wanted a refrigerator, they'd open up a line of credit with the appliance company. If they needed $700 for a car repair, they'd go to the local personal finance company and borrow and pay it off in time. Credit cards came along and got rid of all those. Nowadays, you buy a refrigerator on your credit card or put your car repair on your credit card. Now, why did that happen? Partly it was because of developments in information technology, right, that allowed credit cards to reach economies of scale and information that we didn't have previously. A large spur of it was the 1978 Supreme Court decision, which basically deregulated interest rates by saying that the interest rate would be set by the state of the bank, not by the state of the consumer. Which then led a lot of banks to gravitate towards Delaware and South Dakota, which had no usury ceilings. And the effect of that then was to deregulate interest rates, which was probably the most important part, along with state laws deregulating interest rates. Because one of the reasons we had so much installment credit was that it was tied to retailers. The big department stores, for example, appliance stores, that sort of thing, could offer you both credit and the goods, and they would tie them together. And what we saw in the past was, in states with strict interest rate ceilings, they simply raised the price of the goods that you would buy, right? Mm-hmm. So one study found that in Arkansas that had strict interest rate ceilings, the same refrigerator cost 8% more than it did in Texas, right across the state line, because they were making up for their credit losses by raising the price of the goods. Deregulating interest rates allowed credit cards to become unhooked from the transactions for the goods, allowed consumers to shop for the lowest price on the goods, best quality, and separately shop for the credit cards. And so what we see in the data then is credit cards become just a more efficient way of delivering credit for consumers. It's more efficient for merchants because merchants don't have to bear the risk and cost of running in-house credit operations. Not to mention the fact that merchants never really like to collect on debt because they risk alienating a potentially good customer. And overall, it just was a better way of conducting business than the old retail store installment loans that we saw in the past. So overall, there's no evidence that credit cards have increased indebtedness for consumers. It's just been a substitution from all these installment forms of credit to credit cards.
So this is fascinating, and it's a really kind of counterintuitive or counter-narrative story about consumer credit and how it works, because usually I hear, this is terrible and people, are taking out credit when they shouldn't, and they're, using credit unwisely and so on and so forth. Why is that narrative so powerful? And how do you respond to people who sort of find it compelling?
Yeah, it's interesting because and let me stress that it's absolutely true that there are people who get into trouble with credit, who overuse credit to their detriment and end up in bankruptcy and that sort of thing. But I think the lesson I've learned from looking at the history is there have always been people who have overused credit, and obviously people who've always used credit to live beyond their means. But it seems like it's always actually been a minority of people who do that. Now, why is it that we have these strong perceptions of the world that seem to me to be out of step with the reality? I think there's two things. One is, as I have to talk about, is what we call the other guy effect. Which is all of us, when we look at our own finances, think, well, I'm obviously using credit responsibly. I'm living within my means. I don't buy things I can't afford. But it's the other guy. It's everybody else, right? And as I like to say, either we're all ourselves or we're all the other guy. They can't both be true. So I think our perceptions of other people may be clouded for whatever reason psychologically. To look different from our perceptions of ourselves. I think the second thing is that the deep-seated in our psychology is reinforced by academic ideas, I think, is kind of a fear of consumer credit, which is we all understand business credit is productive. That took us a long time in human history to understand the idea of risk and investment, that I could actually, because the natural tendency, as we say in the Bible, 7 years of famine, 7 years of feast followed by 7 years of famine, right? And the historic perception was that consumer credit is nothing more than kind of eating your seed corn, consuming more today and can't consume more later, right? We eventually came to understand that for businesses, investment makes sense, that I can actually borrow today and pay interest and end up wealthier because I can increase my productivity if I buy a new backhoe or computer system or delivery van or whatever. It's much harder to see how that operates with consumers, which is to understand that what a lot of consumers are buying are actually in the nature of a capital investment, that a washing machine is actually a capital investment and not just consumption. It's not just buying a pizza or a nice dinner. All right, that's harder for people to grasp, and so I think it actually requires kind of a recalibration of our views to think about how consumers might use credit productively. I'll just give one last example. Adam Smith himself was a great skeptic of consumer credit, supporter of business credit, skeptic of consumer credit for exactly this reason, which is great Adam Smith saw business credit as productive and consumer credit as simply living high on the hog today and then not having as much in the future. So it's even the smartest people don't always appreciate that.
Okay, so you're telling a really fascinating and counterintuitive story about how we might actually socially benefit from liberalizing access to consumer credit and kind of adopting a kind of a more or less regulated or deregulatory approach to thinking about consumer credit, it sounds like to me, but which is fascinating, right? And you make a really compelling case for it. I'm wondering if the perspective that you've taken on the nature of consumer credit and how it interacts with the economy more broadly has caused you to think at all about how we might still want to regulate consumer credit in some ways, because presumably there are some ways we could regulate that would make the market work even more efficiently than it currently does.
Absolutely, and I want to make clear, I think that there's plenty of room for sound regulation in this area. Obviously, most obviously against fraud and deception, those sorts of things. Obviously, it's important to have clear understanding and not and the like. But I think a more interesting question is the larger questions of consumer credit regulation. And the way I think about this is you can think about regulation from two different perspectives. I call it market reinforcing versus market replacing regulation. What we've traditionally followed is a system of market replacing regulation, where you simply ban products such as payday loans or set terms such as interest rates, right, or prohibit terms in that sort of thing. Now the problem with that is that you can get rid of the supply of a product, but you can't get rid of the demand. And so what we've seen recurrently in American history is every time we try to engage in market replacing regulation and we take away choices from consumers, it ends up hurting consumers overall, right? And in particular, the biggest concern